Alright class, this is part 2 of the chapter 6 video lecture. So let's continue with non-deductible payments like illegal payments or fines and penalties charged by the government. Let me talk about this one first. So let's say that you pay your taxes late. It's something common. People underestimate how much they owe, so they don't pay the exact amount. Well, possibly the government will charge a penalty, and that penalty, even though it's an expense, you cannot deduct it. You cannot benefit from it. It's contrary to public policy to give the taxpayer benefit of paying a penalty. Now, this penalty or fine is assessed by the government, county, state, city, federal. If the fine or penalty is assessed or charged by another company, a business, then that penalty or fine is more of a nature of maybe an interest. Like if you pay your credit card bill, let's say a business credit card, yeah, not a personal credit card, but a business credit card payment late to the credit card company. That penalty they charge you is really an interest that you can deduct as a regular trade or business expense. Illegal payments include things like bribes, kickbacks, and those are non-deductible. Those are crimes, and you cannot benefit from the crime. There's a difference between kickbacks and rebates. Kickbacks are illegal. Kickbacks are non-deductible. Rebates are really just additional costs of doing business. The person receiving the kickback is also committing a crime, right? Taking a bribe. And you're committing a crime by paying this bribe. A rebate is just a reduction to whoever is buying stuff from you. Typically, it's the business itself is that getting back the rebate or the owner of the business. Now, if this so-called rebate is going back to someone other than the company, other than the owner, really then it's an illegal kickback. So the typical situation you may hear is a company manager, possibly a purchasing agent for a company, and they direct a lot of the purchases to a certain vendor, and the vendor will give money back to this agent, not to the company. Yeah, maybe paying them off with trips to Vegas or gold Rolex wristwatches. Yeah, that is a kickback that's illegal, non-deductible to the payer, although it is income. As we learned in past chapters, illegal income is taxable to whoever is receiving it. Let's see. Illegal income is still reported as taxable income to whoever is receiving it. Now, if the activity is illegal, you still can deduct the other ordinary necessary trade or business expenses. You cannot deduct the bribe or the kickback or government fines and penalties, even though the business is illegal, yeah? But these other expenses still deductible. The exception is trafficking in drugs. In the news recently here in Hawaii is the medical marijuana stores opening up, and it's legal under state law, but marijuana is still a illegal drug for federal purposes. So I'm not sure whether these expenses here would be deductible if they're filing a federal income tax return. I'm not sure. Okay, some other non-deductible costs for a business would be anything for lobbying and political contributions. An exception to that is if a business incurs a cost to influence, looks like county or city type rulings in favor of a business, something like the zoning to get it rezoned so they can do a certain type of business in that area. Otherwise, any type of lobbying or political contribution, you still can pay it. It's not illegal, but you cannot deduct it. Um, Another type of not non-deductible, but maybe it has to be capitalized costs, is if you incur costs to investigate whether you should open up a new business activity. And that type of costs you cannot deduct until you start the activity. If you're investigating, doing market research, maybe doing a business plan to check the feasibility of a new activity, then you have to wait before you can deduct it. If you haven't started up the business this year, you gotta wait to next year to possibly deduct the costs. At the time you start the business, then up to $5,000 of that cost can be deducted at one time. And the rest of the cost, if it went over 5,000, really over 55,000, there's a phase out of this 5,000 deduction. Any undeductible or capitalized costs can now be amortized over the next 15 years from the time you start the business. The start would be really when you start opening your doors to the public for sales or start holding yourself to um, do work for your customers. So here's a flow chart just for investigation costs. So here we're saying are expenses incurred by the taxpayer already established in a similar business. So let's say that you already have a restaurant at one site and you want to determine whether you should open up another uh, restaurant site. So you do your investigation. And right away, because you're already in the business, all of that additional cost to investigate whether you should open up another site is going to be deductible right away, just like any other operating costs. But let's say that you're not in the restaurant business, or maybe you have a business. Let's say you have you're a mechanic, auto mechanic shop, and you're considering to opening up a restaurant. Well, different business, yeah. So you're not already in an established business in that restaurant. So you're going to say no here. So all the while you're incurring costs to investigate whether you should do that startup. And here you say, no, I don't think I'll do it. Well, then all of that investigated costs to determine whether you should open up that initial restaurant is not deductible because you never were in that business. But here, once you determine, yes, I'll start that business, now you're going to capitalize that cost and wait and until you open the business. And then at that point, you can deduct up to that $5,000 of costs. And anything that you cannot deduct right away, you're going to amortize, capitalize and amortize over 180 months or 15 years. Here's a little bit more extended timeline. So here again, you're investigating the business. And if you already are in that business and all you're doing is investigating where you should expand it or maybe sell a similar line, maybe you're already in the men's clothing and now you want to open up a women's clothing line. That's a similar business and you're investigating it. Well, that cost is deductible right away. You're already in that business. But if you're not in that activity, now here you're going to wait and now make a decision whether you're going to get into that new line of business. And if no, then all of that investigated cost is non-deductible. If yes, then you wait until you open your business. Then you get to deduct that 5,000 or amortize over the rest of the next 180 months. Once you make the decision to open, now you have to get ready to open. Things like training your employees, hiring and training, setting up, and you're running that new place. You're incurring lots of costs over here, but you cannot deduct it until right here, up to 5,000, and then deduct the regular operating expenses from this point, and any of that amortized cost for the next 180 months. This is the code section for this rule here, I believe, is section 192. And the regular trade or business expenses right here, 162. You should be familiar with the accrual basis method of accounting. Well, for most small businesses, for most service type businesses, they use the cash receipts and disbursements method of accounting for their tax return. And we've learned this rules for income in the previous chapters. Now we're looking at deductible expenses for cash method. And of course, the main rule is you get to deduct it when you pay it. Exceptions, though, there's always exceptions, is if you prepay expenses, you can't generally deduct it. Or here, if you prepay interest ahead of time before it's due, you usually cannot deduct it. These are exceptions, yeah, to the general rule, but there's exceptions to the exceptions. Here it says that you may be able to deduct prepaid expenses if the amount you pay for is going to be for a payment for less than or equal to 1 year. In other words, if I pay it right now here in the month of September for 1 year, and it's not going to extend beyond August of next year, whatever I'm paying for, then I get to deduct it right now when I pay it. Yeah, it's less than or equal to 1 year. Now, if it goes beyond the next 12 months and I pay it right now, I only can deduct from now, here this month of September. Let's see if I can draw it out. Right now for me, it's September 2017. And if I pay 12 months worth, that means all the way through August of 2018. And here's my year end, December 31st, 2017. If I pay right now for this period of time, I get to deduct all of this right now in this current year of 2017. But if I'm paying for something beyond 12 months, like out to here, I only can deduct September, October, November, December's worth right here for 2017. And the rest would be considered prepaid and deducted next year. Whatever falls in 2018 gets deducted in 2018. Another exception is if the landlord requires you to prepay rent. Yeah, it has to be probably in a written contract. Now keep in mind that a security deposit is not rent. A security deposit should be probably treated as a receivable from your landlord and only treated as a deduction if at the time the lease is over, both parties agree that it's going to be treated as the last month's rent, or the landlord says, I'm going to keep this security deposit for the damages you've made. Then it's going to be treated as an expense by the tenant at that time, not at the time of the payment. Prepaid interest, again, the general rule is you cannot deduct more than what's already due. But there's an exception to this exception, and that's points paid with the taking out of a mortgage for a personal residence. Here it says that the amount has to be stated as points when you borrow the money from the financial institution. Points are usually stated as a percent of the amount being borrowed. Like 1 point would be 1% of the loan. And you paying this upfront just to get the right to borrow the money. This is one of the main ways mortgage brokers, financial institutions make money by charging these fees upfront and not really the interest over the life of the loan. In fact, they want you to refinance almost right away because now they can charge some more points. Here it says points are something that's an established practice in that area. So usually in certain areas of the US, there's a certain practice of charging so many points for certain types of loans. and it has to be paid. This mortgage has to be taken out and the points paid to buy your main home. Okay, and the mortgage, the security has to be that home. Here it says that the refinancing of an old mortgage, if you pay points to refinance, you cannot deduct the points because you're not buying a new home, right? So any of those points you pay on the refinance has to be capitalized and spread over, amortized over the new loan. And if you refinance this loan again, any unamortized points you can deduct at that point, and any new points on the new loan has to be capitalized and amortized over the new loan. That points is going to be combined with the regular interest and deducted as an itemized deduction on Schedule A. Points can be probably identified on the settlement statement when you close on a purchase or sale of a home. So um, very practical because you have these two columns, yeah, and sources and uses. So it's almost like debits and credits. And one of the fields, one of the items here for settlement charges are the origination charges or points over here. Yeah. So typically it'll show up here for the borrower. Now, if the seller pays the points, that's possible in the case of what they call VA, Veterans Administration, or Federal Housing Administration loans to help these borrowers here using this type of financing. They charge the seller, not the borrower, to pay the points. But in that case, the borrower is still considered to have paid it and get the deduction. Here's the tax form 1098 that reports mortgage interest right here. And also in the year the money is first borrowed, taken out, the points are reported here. And these two are combined together, whatever that total is, and reported on the Schedule A, itemized deduction, here in the interest section, here in line 10, home mortgage interest and points reported to you on Form 1098. Now, if again the points have to be capitalized and amortized, you cannot deduct the whole thing here. So probably here in line 12 is where you will report the amortized points and adding up all this interest to get a subtotal for the interest category of itemized deductions. Added to all the other itemized deductions to get a total here. And again, we'll spend another chapter on just itemized deductions, some future chapter. Let's go to the method of accounting that you should already be familiar with, accrual basis. And for tax purposes, we have two main tests here, one called all events and one called doing it, economic performance. All events means that the payer actually legally owes the liability because the work is done, the service has been performed, and the amount is set. It's not going to vary. Yeah, that's the all events. And then the economic performance, meaning the work has to be done, has to also be there. But there's an exception to that. And the main exception is that because certain types of costs are reoccurring every year, repeating every year, here, repeating, it's pretty much going to be the same if you allocate it by month. Let me give you an example again. So let's say it's September again, 2017, and I'm incurring a bill for 1 year. Yeah, and that the 1 year is beyond December 31st. But after this year's over, I'm going to renew my bill again. And that also happened in the previous period. So in every 12 months, I'm pretty much going to incur the same costs. It's kind of immaterial, the difference, but I'm recurring. So stuff like maintenance contracts. I know in the case of photocopying contracts, it's always reoccurring, but it doesn't fall at the beginning or the end of your year, yeah? falls kind of in the middle. But for every 12-month period, it's pretty much the same. So once you get the bill, I'll deduct the whole thing already, even though it overlaps to the next period. Wash sales is another area that will restrict a deduction for losses. So let's have a sale right here. And then the cost basis or the adjusted basis is bigger than the sales price. So we have a loss. So in the case of stocks and securities, one of the planning techniques we learned in the previous chapter is to harvest these losses so we can reduce the amount of taxes we owe for the year. But if you repurchase within 30 days from this sales date the same or similar type securities, let's say I'm going to say stock here, you're going to buy it again, the thing you sold here, you're left in the same place, right? You had the stock here and you had the stock here, but now you're claiming a loss. This is called a wash sale. The same thing would happen is if, let's say, you anticipate this sale and you buy the stock, more stock over here. You already had this stock and you're buying some more 30 days earlier before you sell the old one and create that, they call it artificial loss, yeah? You're still in the same position. You have the stock and you sold the old one and you generated an artificial loss. Again, this is called a wash sale. So if you really want to claim this loss, you buy it earlier than 30 days before the sale or later than 30 days after the sale. And now you can deduct this loss. If you do have a wash sale, the cost basis of this stock and the cost basis of this stock is what you bought it at and reduced by the unrecognized loss here. So now when you sell this subsequent stock, you're going to get a bigger loss or a smaller gain that you can report. If you buy and sell all of these shares of stock with the same broker in the same account, they'll probably keep track of wash sales for you. Another place where you cannot deduct a loss or possibly postpone a loss is if you sell an asset and have a loss to a related party. So let's see if I can illustrate this. Here's our sales price, and again we have an adjusted basis of what we sold and to generate a loss that we're trying to deduct. But if this sale was sold to someone that's related to you, closely related to you, related party that we'll define in a second, this loss is disallowed. And the cost to the related party is whatever they bought it at, and if they sell it at a hopefully gain, here's their sales price minusing what they paid for it. If they have a gain, they can reduce this gain by the disallowed loss of the previous owner. If this gain is not as big as this loss, any excess loss is, here they say, disappeared or wasted. Or if you have a loss over here, you cannot, this loss will disappear forever, and this loss is what gets deductible by this related party. Again, who is a related party to you? Here's you, the taxpayer. And of course, your spouse is a related party, but usually you two would probably file a joint return, so it wouldn't make sense you trying to sell something to your spouse and your spouse later on sells it again, yeah? Children, lineal descendants, grandchildren would be over here, related parties. Here's your parents and grandparents. Here is your siblings. If you sell to them at a loss, you cannot deduct that loss. Yeah, all of this is called section 267 in our Laulima resource chapter resources folder. I have a case paper when I was a student on this topic, and you may want to see how I wrote it up there. Other related parties, if you own a corporation up to a certain percent, if you're the owner here called grantor, or the beneficial owner called beneficiaries, or the controlling persons of a trust. That's a related party. Corporations here would be a related party. Your partnership to you as a partner is a related party. Transactions between the corporation you own and the partnership you're a partner are related party transactions. Or between two corporations you control. That would be related party transactions. Here's even more relationships. If your family, if partners in your partnership own uh, um, stock or partnership interests or beneficial interests, that's going to be constructively owned to you. Here they call it attribution rules. And if you sell between or among these related parties, the loss is not unrecognized. Okay, our last topic is called vacation home. So let's say that you have a residence and then you live here, of course. I'll just call it home. And you live here and then you turn it into a rental. Yeah, you're a landlord now. This is a straight cutoff, yeah? All of this is your home. All of this is your costs here. And we learned that the home mortgage interest and the real property taxes you incur here are deductible. And here, this is a production of income activity. And all of the costs here should be deductible for rental purposes. There may be limitations we'll learn in a future chapter. Or it could be the other way around. You have a rental property over here and you kick your tenants out and now you treat that property as a home. Prior to this change, you have rental expenses all deductible. And from this point on, the only thing that's deductible is your mortgage interest and real property taxes as an itemized deduction. Okay, straight cutoff. This is assuming that this has been going on for a while and this will go on for a while. And you're not flip-flopping back and forth between the two uses, personal residence and rental real estate, during the year. Okay. Now, if you do that flip-flopping back, so many days here, so many days here, switching over, that's called a vacation home situation. And certain rules will restrict the amount you can deduct. And I kind of summarize it in this table here. 1, 2, 3, 4, 5 possible situations. I have it divided up on the two extreme ends here. Here is where the property is used 100% for personal use, your own home, your residence. Of course, you're not going to have any rental income to report here. You're not going to pay rental yourself, and you're not going to have any rental expenses. The only expenses you get to deduct is your home mortgage interest and real estate taxes as itemized deductions on Schedule A. At the other extreme is when you have the property used as a rental property for the whole year. So now all of the rent income is going to be taxable. And all of the rental operating expenses are going to be deductible, again, subject to something called passive loss limitation rules that we'll learn. And if you have a loss, the loss should be deductible. Let's go to this situation here. You use the home primarily as your residence, personal residence, but you rent it out for less than 15 days during the year. In other words, 14 days or less. And you know all that rent income you collected for that 14 days or less for the year? All of that income is tax-free. One of the few places under the tax code that you have a free income. You don't have to report it. But you can't report any rental expenses for those 14 or less days. You still get to deduct all of your home mortgage interest and real property taxes as an itemized deduction on Schedule A. Now let's say that you rent your property for 15 or more days during the year and you use that same property for the larger of 14 days for the year or 10% of the days rented. It gets a little bit confusing here. Let's say that you rented the property for 200 days during the year. 10% of that is 20 days. 14 or 20, the larger would be 20. And if you use that place for more than 20 days in the year, it falls within this category. Again, renting it for more than or equal to 15 days and using it for, in this case, more than 20 days out of 200 rental days. You now the personal use, and this is the renting days here. And this rules would apply. You got to report all your income. And now the rental expenses you get to deduct is based upon a ratio. The ratio is the rented days divided by the personal days plus the rented days. You use that ratio and you multiply all the expenses, and that's what you deduct for the rental. Now there's some controversy in terms of how much interest and real property tax you can claim. Here it says that the ratio you can use is the rental days divided by 360 days in the year, and not the total use, be it rental and personal. Yeah, using 360 as the denominator here. Now, if the amount of expenses here allocated to the rental are larger than the rental income, here it says that the rental loss is non-deductible under this vacation home rules. Now, the personal part of the mortgage and the personal part of the real estate taxes can be deducted as itemized deductions on Schedule A. Again, you're allocating it between itemized personal and rental here on the Schedule E based on the amount of days. Okay, let's change the facts here. We're still renting it for more than 15 days or at least 15 days. And you notice how the sign changes here? The personal days are less than or equal to the larger of the 14 or that 10% of the days rented. In other words, the personal days are kind of smaller now compared to over here. You still include all the income. You still have to allocate all the expenses like we did over here. But now, if there is a loss, the loss is deductible. Okay, so the tricky one is over here. No loss deduction allowed. And you gotta go through this day test over here. This handout is in the Laulima chapter resources folder. Okay, so let's end it here. If you have questions, you know how to get a hold of me, my email. Okay, talk to you later.